Since my last portfolio update, the 2022 stock market crash has continued. The S&P 500 was down as much as 18.5% year to date. Many companies, especially those classified as growth stocks, have plummeted in valuation. However, a lot of my dividend-paying stocks have outperformed in this time. Today, we're going to discuss a few reasons why this is. Also, I'm going to address the arguments that many investors have against dividends, such as the dividend irrelevance theory. In this video, I'm going to share my new buys, analyze the performance of my long-term dividend stock portfolio, and at the end, debunk some of these dividend myths. My name is Zach, and you should leave a like and subscribe to the channel if you enjoyed the video. These monthly portfolio updates document my dividend investing journey. They help clarify my own strategy and hopefully motivate others to invest as well. Throughout this update, I'm going to be using my own dividend investing software, which is available at dividenddata.com. It allows me to analyze my portfolios, track my dividend income, and conduct in-depth research on companies. If you like what you see, then sign up with the link in the description. My current dividend portfolio value is $107,278. I'm up $22,813 overall, which is a 27% return on dollars invested. In total, I've invested $84,464. This account is focused on building long-term positions in quality companies that reliably grow their dividends on an annual basis. Dividend Growth Investing narrows my focus to companies with stable and growing free cash flow. This is one of the reasons why my portfolio is only slightly down in this environment compared to other investors who are getting clobbered. We'll talk more about this later. My best performers are energy stocks like ExxonMobil and Chevron. I bought these back in 2020 when they were deeply out of favor by the market. Both have generated serious returns while paying out big dividends. My total return on ExxonMobil is 160%. My position is currently valued at $14,656. From reinvesting my Exxon dividends, I gained 14.67 more shares. This added significantly to my total return and future dividend income. My total return on Chevron is 102%, and my position is currently valued at $3,460. Despite their great performance, I've not added to these oil stocks other than reinvested dividends. I will continue to hold for the long term and collect my dividends at a fantastic yield on cost. AT&T, which has been one of my worst performers over the past year, is finally starting to get some love in the market. I now have a total return of 11%. Altria, ticker symbol MO, is performing very well. I now have a total return of 36%. This company pays a huge dividend and generates reliable free cash flow. In today's market, companies that already generate large amounts of free cash flow and distribute those earnings to investors through dividends are holding up better. In my portfolio, the two worst performers are the companies that don't currently pay dividends: Disney and Warner Bros. Discovery. Over the long term, I think these companies will generate sizable free cash flow, but right now they are in a transitional phase with streaming being unprofitable. Today's market is very focused on what companies are generating right now. Stocks with valuations reliant on future growth are being sold off en masse. This can lead to a great buying opportunity for many of those high-quality growth names. In the 2022 crash, my buying has been focused on these discounted higher-growth companies. However, I'm still focusing on the subset of companies that I think will have growing free cash flow and dividends over the long term. Since my last update, I bought $1,254 of new stocks. I bought one share of Microsoft at a cost of $264.78, 2 shares of T. Rowe Price at a cost per share of $122.97, 2 shares of Disney at a cost per share of $108.78, 1 share of Visa at a cost of $196.71, 4 shares of Intel at a cost per share of $43.85, and 1 share of Apple at $153.76. Additionally, I reinvested my dividends in AT&T, O, Apple, and EPD. These reinvestments can be significant. For example, my AT&T dividend allowed me to acquire 7.45 more shares. This will increase my future dividend income, allowing me to acquire more shares, adding to the dividend snowball effect. Over 41 of my AT&T shares are from reinvesting dividends. Let's look at the diversification of my portfolio by current value. Communication services is my largest sector at $25,000, led by Disney and AT&T. This is followed by energy at $21,000, with ExxonMobil as my largest position. Then we have consumer defensive and technology, which are both around $18,500. Let's see how these investments translate to my dividend income. In total, I've earned around $5,583.43 in dividends and $1,367 so far in 2022. This graph shows my dividend income month by month. You can see the growth over time. The orange line shows the 3-month rolling average, which is $267 at the end of May. The reason for its recent decline is that one of my largest dividend payers, AT&T, had a dividend reduction after their Warner Media spinoff with Discovery. In May, I earned $210 in dividends. This includes $141.73 from AT&T, $52.40 from EPD, $10.52 from Apple, and $5.34 from O. In June, my dividend income is estimated to be my largest month ever. Notable upcoming dividends include $22 from Intel, $17 from Kroger, $20 from the J.M. Smucker Company, $20 from Microsoft, $28 from Chevron, $61 from Walgreens, $134 from ExxonMobil, $36 from 3M, $22 from PepsiCo, and many more. Now let's get to the topic of the day, debunking dividend myths. As a dividend investor, you'll often encounter those who criticize your investing strategy. They say things like dividends come directly out of the stock price, or that receiving a dividend is equivalent to selling your shares. Now, if you've ever owned a dividend-paying stock, then you know the first argument is quite ridiculous. Dividend payments do not come directly out of the stock price. The two have no direct correlation, and stock prices can often go up when dividends are paid. The origin of this argument comes from a small hint of truth. When a company pays a dividend, it is distributing part of its cash profits to its shareholders. If the company retained those earnings, then they could theoretically be more valuable, thus increasing the stock price. However, not every business can intelligently reinvest all their profits to grow the business. In that situation, it's better for the profits to be distributed via dividends so that investors can choose how to reinvest elsewhere. We'll discuss this in more detail later. The other argument is that receiving a dividend is equivalent to selling part of your shares. This is not true. A dividend is just a distribution of cash profits. You still retain all of your ownership in the future earning power of that business. When you sell shares, you're decreasing your ownership percentage of that stock. You own less of the business and future earning power. In perpetuity, that strategy would result in losing all your ownership. Warren Buffett, one of the greatest investors of all time, owns many dividend-paying stocks. In the following clip, he gives the best explanation of how to think about dividends.
The answer is I do believe in dividends in a great many situations, including many of the ones companies in which we own stock. The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain. And there are many businesses. Take See's Candy, which we own. See's Candy has paid everything virtually out to us that they've earned because they do not have the ability within See's Candy to use large sums, which they earn, intelligently in their business. So it would be an enormous mistake for See's Candy to retain money. So they distributed Berkshire, and we hope that we move that around in some other area where that dollar becomes worth $1.10 or $1.20 in terms of present value terms. But if the time comes, and it will come someday, if the time comes when we don't think we can use the money effectively to create more than $1 of market value per dollar retained, then it should be paid out. And like I say, we do that individually within Berkshire, but because we have this ability to redistribute money in a tax-efficient way within the company, we probably had more reason to retain all of our earnings. If See's Candy were a standalone company we would simply pay out a lot of the earnings, practically all of the earnings and dividends, just like we do now, except it goes to Berkshire. That we like the companies in which we have investments to pay to us the money they can't use efficiently in their own business. In some cases, that's 100% of what they earn. In some cases, it's 0% of the earn. We own some stocks that don't pay any dividends.
This is the best fundamental reasoning for how to think about dividends as a business owner. See's Candy is a great example. That company makes far more than they can intelligently reinvest back into their business, so they distribute their profits out to the owners. This applies to so many companies. Take the Coca-Cola Company, for example. They generate over $10 billion a year in free cash flow. They already have such an established, dominant position in their core business. Reinvesting all those profits would have negligible returns. It's better to distribute a large percentage of profits to owners. Retained earnings do not always create more value. That is only true if they invest those retained earnings intelligently to create more value. There are plenty of fantastic companies that do just that. Warren Buffett's Berkshire Hathaway is a great example. They retain all their earnings to invest and acquire more businesses. They are unique in that they're in the business of buying businesses. Other great companies that don't pay dividends include Alphabet and Amazon. So far, they've been able to create new businesses and make acquisitions that increase shareholder value. Every company is in a unique situation. As a dividend growth investor, I try to find quality companies with growing free cash flows that distribute part of their earnings as dividends. I then reinvest those dividends to acquire ownership in the same company or another. I look at my portfolio as a mini Berkshire Hathaway. Dividends give me the option to reinvest and increase compounding, or choose to live off these dividend payments. Right now, I'm in the reinvesting and compounding phase of life. Ideally, my portfolio will grow to a point where my dividends far exceed my personal expenses and I can continue reinvesting indefinitely. Thank you for watching Dividend Data. You can sign up for dividenddata.com to use this software and join a Discord community of like-minded investors. If you follow me on Twitter, link in the description, you can get real-time updates of my buys and dividends coming in. Link in the description. Please leave a comment below, and thank you for watching.